How do I combine stock options with value investing ideas? Hi, my name is Gary Mishers. I'm the managing partner and chief investment officer of Silver Ring Value Partners. I also teach the value investing seminar at the FW Olin Graduate School of Business. So I've had a few advanced students kind of ask me, how do you use options in a way that's consistent with the value investing approach? And I would say before you go any further, if you don't have really solid fundamentals as far as investing in stocks from an intrinsic value perspective, just stop right there. Don't listen to this video. It's gonna do it's gonna do you more harm than good. And I say it not to be condescending, but because I don't think that an advanced topic like this is going to be helpful to you if you're still earlier in your journey. I would save this for another time. So before I kind of dive into answering, first of all, I have not mastered everything there is to know about options by any means. I actually used to think, up until a few years ago, that basically options was, kind of a speculative. Using options is kind of a speculative endeavor. It has very little to do with investing, and you kind of end up just speculating and gambling essentially, right? And by the way, I think that that is how most people approach using options, and I think that there are many times when there isn't a good value investing based way to use an option strategy, either on its own or in conjunction with investing in the underlying security to create a better opportunity. I think that there's a small percentage, and I want to stress small percentage of cases where if you use a value investing lens on stock options investing, you can find a much bigger uh, price to value gap than merely doing working with just the underlying securities of stocks and bonds. And I think the mental model you need to have to spot these opportunities is, what's the probability distribution that's used to value the option in the market, number one, and how does that compare to the probability distribution of the underlying? Now, let me give you, kind of a more concrete example without going to specific securities because I don't think that that's appropriate in this venue. But the Black-Scholes formula essentially assumes that stocks are a random walk, and meaning that they're just as likely to be higher or lower, and that it prices options based on kind of drawing a bell curve around the current price, the current market price, and it has a drift term, and the drift term is the risk-free rate. Again, I'm simplifying, so if you're an options guru, and you think I'm off on the details, feel free to leave me a comment below and educate me, because again, I'm not talking about to the formula to the finest degree, but I'm talking about the general idea is, if stock is at $10, the bell curve is drawn around that $10, and that's kind of how the Black-Scholes prices the option. Essentially, it tries to figure out how likely is it for a stock to randomly go from $10 to some other point. And again, it's assuming that the only reason the stock would move is randomness, right? Okay, so that's the mental model that the market uses. Basically, looks at stocks as random stochastic processes. Now, if you have a stock which has a very different, in your view, probability distribution of outcomes, and you kind of overlap that distribution on the market's bell curve distribution, you see two very different distributions. That is a potential opportunity for using an option. For example, you can think of a company where there's a lot of right tail possibilities. By right tail, I mean there's a lot of good things that can happen to create extreme value for the business. And I recently presented on a company which I own. Again, I'm not going to talk about the name because it's not appropriate in this venue, but it's a company that I own where there are two businesses, and one is a mundane, stable business, and another is a younger, early stage, really good business with rapid growth, but a much wider range of outcomes. So if this company just had this old mature business, you would have a normal kind of distribution of outcomes. But here you have a second business where it's either worth a little bit, or it's worth huge amount, right? And it's not exactly bimodal, meaning it's not like only two values are possible, but it has a skew to the right in that probability distribution. So it's no longer just a standard symmetrical bell curve. So here's an example where the market, the people who set the prices for options aren't going to be, thinking about that nuance. They're going to be pricing every stock option on the same standard model. And if you have a very different view of the probability, kind of distribution of values, then you might be able to find some ideas of how to use an option in that case. Another situation is, what I call extreme options. And extreme options is when, let's say I have a stock that is worth 100, it was at 100, and all of a sudden the stock drops to 20. That's very rare, right? But it's happened in recent months, in March and April. And let's say you think the value is only gone from 100 to 80. So now the stock market, the way it's going to price options is, it's going to say, look, the probability of the stock going from 20 to 80 is tiny, tiny, tiny. We have to quadruple, even if the implied volatility factor in the Black-Scholes model really goes up. It's still not going. The stock option, the call option price is not going to go up nearly enough, as if you believe that, hey, the business is still worth 80, and over the next year, there's certainly no certainty that that value will be realized, but there is a pretty decent chance. While the market is going to price this option at a tiny, tiny price, implying a very small chance, much smaller than your assessment implies. So that's another example. Again, these are rare, and I would say most of the time, if you never use options and you just invest in companies, you'll do just fine, assuming you know what you're doing and you're following a solid process. But occasionally, there are ways to create better risk rewards or create, find great opportunities not available in a small way. Again, I'm not suggesting you should have a portfolio full of options, but it's a way to maybe augment what you're doing very infrequently. Anyway, I hope this has been helpful to you. If this has, please hit like and subscribe to my YouTube channel. Thank you.